Hello, welcome to Introduction to Business. My name is Dr. George Mochocki. This is a series of chapters you've taken with me. This is the last one of the series of 20 chapters. This week going to be talking about financial institutions, or what we would commonly call the banking industry. So the Federal Reserve is the banking industry here. So let's go on with our quick overview. Okay, now make sure you print out your concept maps from within the Blackboard course management system that you're taking with this class. Print out your concept maps. You're usually at the first level or maybe at the second level. So right now I got Ben Bernicki and he's going to be gone. So we're going to replace him with who? And we're replacing him. There's the lady that's going to be replaced. He's going to be replaced by a woman, chief financial officer, and we will discuss that within our forums. So I'm going to leave that open right now. So a little bit about the Federal Reserve. He or she now, if I'm looking at the chairperson of the Federal Reserve, it's going to be a woman. What are the skills? What are their ability? Because they basically bring the second most powerful individual in the United States next to the President of the United States, because they can control the banking or the financial institution, the money side of the economy. Okay, so we got the Federal Reserve. Now, what's money? And again, when you look at this one, it's basically telling you what's money. Money is before money, you would barter, you exchange one thing to the other thing. It didn't make sense if I wanted like just two eggs instead of a dozen eggs. How am I going to give like they said, if I had a chicken or I had a ham or a pig, how do I just cut off one pig and still have something I could divide? So that's where money came into existence. And if you're looking, what's the new things that's threatening the money is the Bitcoin. Bitcoin is another way of of a system that's divisible, but it's off the grid, for lack of a better word. So we'll talk about money, but for now we're just going to talk about money as we know it from the financial system. So we have money, for money to be viable, it has to be portable, divisible, stable, durable, and it has to be unique. Okay, so that takes care of money. What's our money supply? If I look at the money supply, after you read the chapter, this ties into our economic chapter that we did earlier in chapter 2. Remember, this whole course is an overview of all the different functionalities and different disciplines within the business. Any business, small or large, they all have to have the same functionality and disciplines within the business to operate. So when I'm looking at this one, the one thing I have to look at money, M1, M2, M3, concentrate on M2. M2 is basically taking M1, which is money, currency, and everything else, and that may take a little time to obtain, plus your savings accounts and mutual funds are all tied into M2, because when we learned earlier, the liquidity, how liquid is an asset. The most liquid asset is cash. The next most liquid asset would be your savings account. The next, because you could take it right away, maybe some penalty. The next one would be your, from a business perspective, would be your accounts receivable or IOU. And so liquidity is the most liquid and works to, it's still liquid. Like if I look at a building, it takes me a little while to sell the building, so it's not as liquid as if I got cash or a debit card or money in the savings account. Okay, so most economic systems are looking at M2 when you do the formulas. What's the global exchange rate? Is the falling dollars. Remember, when a dollar falls, what does that mean? That means that our dollar is weak. So if it's weak, that means people buying our goods are less expensive. So more people buy our goods. So if we're exporting, our goods become cheaper because our dollar is weaker. They could get more for when they convert their currency to the U.S. dollar. Now, if it's a strong dollar, it's in reverse. Because if it's a strong dollar, that means I get my dollar is strong, so it takes more dollars to buy some goods. But if I have strong dollars, instead of exporting my goods, that's when I start importing, because then I could get more for my dollar. So from a business perspective, from a banking perspective, from a global exchange rate, businesses are looking, what is the exchange rate? How much for every dollar? How many pesos do I get? How many rubles do I get? How many marks do I get? How many yens do I get? It's a conversion factor. So now we're comparing apples to apples within the economy. Right now the dollar is stronger. If it's weaker, then it's going to to cost me more if I want to exchange it to that currency that I'm doing business with. Okay, so make sure you understand the global exchange rate, the Federal Reserve System. When you look at the Federal Reserve System, all this comes into play. When you look in the book, it says the 12 Federal Reserve Banks. I think we're in Reserve Bank number 7. This is with the Chicago land area, and the Federal Reserve Bank takes all the different economic indicators, unemployment, interest rates, everything else, housing, inflation rates for their districts. Then they take all the different districts to compile it and come up with an average. And that average is basically when you see in the news, they say the U.S. economy is in a recession or it's coming out of a recession. Some parts of the country may say, what recession? We don't see anything. Everything else is going along nicely. Other parts may see it more stringently because it's affecting them. But if I look at the whole nation as a whole, if I put all the grades and everything else together, is where we get our indicators. So remember, when you open up a business, here's what the economy is doing, the macroeconomic indicator for the whole United States. But within the United States, there's some sub areas that are not seeing the same economic impact as or diverse impact as other parts of the United States. So you have to be careful. And then you look at the global, we may be in a downturn, in a recession or depression or coming out. Other countries already are out of that, and their income or their revenue, their banking system, the interest rates and everything else for that economic system in that country is working better. So I would just move my money out of the U.S. market and put it into the Chinese market or put it into the European Union market. We're in a global economy, so remember, banking industries are basically looking at just the United States, our Federal Reserve, but then there's each country has, or different region has their own banking or similar to a Federal Reserve, and then you have what we would call the international banking that's looking at the whole money supply and how do we interact different economies on a global plane. Okay. So you have that to take care of the Federal Reserve. The tools you have to remember. These you're going to see always. These are the main tools. Remember, for the Federal Reserve, when there's an inflation or there is a deflation, and how does the Federal Reserve maintain? You have two aspects of the government that helps to stimulate the economy. One is the government. That's your fiscal policy, to do the taxing and to do the spending. So if I want to pull money out of the economy, I tax more people. That means if I tax more, you have less money to spend. If I want to put money back into the economy from a fiscal perspective, I basically lower the tax. And now they have more money to spend because in that tax, so that gives me more disposable income to buy more goods and services in the economic system, as you're looking at Adam Smith, the invisible hand. Now, the requirements. Now let's go on to the banking system. That's the one aspect, the fiscal. Now we're looking at the banking system, the Federal Reserve, for lack of better words, the U.S. bank. If I look at the Federal Reserve, they have a way of pulling money out of the economy or putting money back into the economy. The first one is the reserve requirements. Each bank has to hold a certain percent of funds against their checking and savings account. Or physically kept in a bank or in a non-interest bearing deposit at the local Federal Reserve. So if the Federal Reserve wants to pull money out of the economy, they raise the reserve requirement. So for every dollar I have in checking or savings, they say you have to have 10 cents or 10% in as a reserve requirement. So that 10% I can't give out to lending or anything else. I just have to maintain it, so it maintains my cash flow and solvency. So if the government wants to put more money back into the economy to get people to spending more, they lower the Federal Reserve requirement from 10% to 5%, and so now they're going to say all you have to do is for every dollar in checking and savings, you just keep a nickel. So now I have 5 more cents that I could lend out and put back into the economy. The next one is open market. When they talk about open market, the Federal Reserve also is a lender and a borrower. So it sells U.S. Treasury bonds and also buys different securities. But so it works on the open market. So if I'm selling U.S. securities, I'm not talking about the savings bonds that you get, but actually U.S. securities savings bonds, IOUs from the U.S. government. So if I want to put money into the market, if I want to take money out of the market, I sell my savings bonds. So look at it this way: if I'm as we talked about in our personal finance, if I have a CD, I have money I can put into a checking account, savings account, very liquid, but I want to get a higher return on my investment. So I say I'm going to put in a commercial deposit or a CD or an IOU or into a treasury bond. So if I take that money from my own personal, I got $500 and I put into CD, I still have the $500, but the restrictions with the CD is that I won't touch that $500 for 6 months and they're going to pay me a higher interest. So what that basically means, I no longer had the money to spend. The disposable income, you know, it's my money. Same thing with the federal open market with the Federal Reserve. If it writes an IOU or sells a bond, it only could print. Remember the fiscal cliff and everything else is coming up. How much money could raise the debt ceiling? So it's like extending my line of credit. So here's the debt ceiling. I can only have so much. I can only print so much paper or so much money to that debt ceiling. That's what they agreed on. That we could. Here's our ability to raise our spending ceiling, our debt ceiling. So I can only print so much money up to that. So now, if I want to put but I got the U.S. bond, so I've got the $500. In my scenario, now I'm spending it. Now I want to put it back in the economy. How do I do it? I either wait till my 6 months is up and pull the money back and put it into my checking or savings so now I can spend it. It's back in the economy. Or the U.S. Or the open market, they'll buy some of their treasury back from China, from other countries. They'll buy them back. So as they're buying back, they're not adding any extra dollars because that's already been established earlier and how much money they could print. But what they're doing is taking the money that's been locked up that somebody else and we're just paying interest. We brought it back. So now those dollars are back into the U.S. checking savings account so we could spend it back in our economy. So that's the open market. The last one is the discount rate. The discount rate works similar to the reserve requirement. The discount rate is the interest rate that banks, that the Federal Reserve charges banks for loans to members, either to keep the reserve requirement or to a little bit low on cash. So when the Federal Reserve announced that the discount rate is at 3%, that's the rate that the Federal Reserve sells to the banks. So if you are looking at discount rate of 3 and you're going for a loan for a car or for a house, you're not going to get at 3% because that's what my distributors or my suppliers, the Federal Reserve, me to the bank. I get it for 3%. I'll charge you 4 or 5%. See what I mean? When we talked about Chapter 15 and utilities and distribution, the Federal Reserve becomes a money handler, a usury. So I'll basically either raise the discount rate or lower the discount rate depending how much money the bank has to loan to its individual members. Okay? Similar to like in the reserve requirements. Okay, commercial banks, if I look at everything from checking everything else, make sure you know these terminology. Demand checking is a technical name for a checking account. We don't call it checking account, we call it demand deposit. The minute I write it, I want my money right away. Okay, certificate of deposit, savings account that earns interest. Most businesses, we just don't keep money laying around. Anything we keep, even to last minute because of technology, we're making some interest on that. We're always making maybe a third, 1.00%, but it's still some interest made on it. The money just not wasting. That's not good business logic or effectiveness of the use of one's capital investment, return on investment. Okay, time deposit, savings account. Bank can require a prior notice before you make a withdrawal. And other services. Those are my commercial banking, U.S. banking systems. You got commercial, you have credit union, non-banks. There used to be with the Glass-Steagall Act that was repealed a few years back, allowed the commercial banks can only do certain types of operations. Savings and loans were only allowed to do in their certain operations that the commercial banks weren't allowed to do. Credit unions could do the checking and savings, but they couldn't write CDs or something else. All that went away. Right now, all of these are just looking at one big banking system because it's a free market system, so every bank was getting to everybody's business. And what happened, they diversified so much that the banking system in the U.S. lost control. They went strictly to free market. That's why we had the crashes, and that's one of the reasons for some of the crashes that you'll find out from the researchers. So they're trying to bring some of the controls back in. If I'm a credit union, I can only do certain things. Now, but once you let that out into the market, could you pull some of the power back? Remember, once you empower an employee, you can't unempower an employee. Once you gave the banks, the credit union, everything else, or the non-banks, this kind of power, it's hard to pull back. So now you have to figure out a way of regulating it, and that's where the banking system's in a dilemma. Okay, savings and loan. If I look at savings and loan, I've got a few more minutes. Those savings and checking, home mortgages, often known as thrift institutes, credit union, is cooperative finance. Remember, as you're a member, sometimes you get a better deal. Remember, when you're getting a better deal on the interest rate, sometimes the banks will always try to outdo the credit unions or savings and loan by going by 0.5% lower interest. When you give that 0.5% lower interest, if you're going to keep the loan for a full amount of time, maybe to your advantage. But what you're giving up is some of your terms and conditions. The things you have to look at is your terms and conditions. What happens if I default? Which one is going to be in more of my favor? Which one's going to throw me right into bankruptcy? You know, because I don't have to volunteer in bankruptcy. If I put my house or something in collateral and the bank wants the money, they could involuntarily force you to go into bankruptcy to get their cash because you put that house as a loan against your business. Remember, if you're a Chapter S or if you're what do you call it, a limited partner or things, they can't go after your personal assets unless you take your personal assets and you utilize them as a collateral for your business, which I do not agree with. I always tell people keep your personal assets separate and keep your business separate. So if your business can't sustain and goes under, okay, you still have a home and everything else that you worked on. You don't lose everything else because of poor business management or something else goes with the economy. Non-banks are like savings. Non-banks, if I look at your State Farm would be considered non-bank. You could get a loan from them. You could have a checking account. Because if you really look at the non-bank, do I have to have a physical banking facility? No, I've got an ATM. I got USAA. It's a military banking institution for anyone that's been in the military, kind of like a credit union membership that you belong to. But the only place they have, I think it's a place in Philadelphia or Washington, I forget where it's at, where they have a main central bank. Everything else, it's all transparent, a virtual banking system. As long as I work at any ATM and any other banking, so if they'll charge me a service fee, but USSSA pays all service fees. So they don't need that capital. They could keep give me better rates and everything else because they don't have all the buildings and all the security and everything else. They're utilizing everybody else's branches and network, and they're just paying the service fee to those institutions, and I don't see that charge. Okay, so those are non-banks. They're on there, they're out there, and State Farm's one that comes to mind. Okay, online banking, make sure you know identity theft, free credit score, and that's something with our forums we're going to be talking about. Processing money, even though if you have a lot of international banks, because we're in a virtual platform now, international banks may have better interest rates. They may have better return on your investments, may have more flexibility, less penalties, but are they insured? If they are insured, they're not insured by the FDIC. That's the U.S. banks operating here with a FDIC insurance. That means they have to meet the minimum requirements and everything else with the Federal Reserve. I'm an international bank out of China, get a good rate in return. Now what happens? If they may have some kind of insurance, the Chinese government may have their own version of the FDIC, Federal Deposit Insurance Corporation. What you have to understand is that other banks in China goes under. It's not that our bank's going to protect them. You have to see what are the rules and how do they pay out because they're protected with the insurance from the Chinese Federal Reserve System or their insurance backing mechanism for that country. Okay. Now, the future of banking, you have electronic fund transfer systems, you have smart card, debit cards, you have the radio frequency that has a microchip in there. So that's all in the future banking. Your $100 bills already has a microchip on there that's tracking the money. You have internet banking. And your international banks, what you have to understand, International Monetary Fund are basically fosters cooperative monetary policies, stabilizes exchanges from one nation to the other. They're basically the global bank that makes sure all the other banking, the Federal Reserve or Chinese Reserve or Chinese Bank, Japanese Bank of Tokyo, all their banks when they're playing on the international field that they play by what they call global standards or global requirements and rules. Okay, so make sure you know the difference between IMF and the World Bank. The World Bank is it's not a banking. It's basically people give into the World Bank and they're just to help developing countries to get out of debt. or lends money to less developed nation, improve their productivity, and helps raise the standards of living. Okay, and money exchanges, ATM, banker's acceptance, letter of credit. For a small business, think of a line of credit. What's the difference between a line of credit and a credit card? All right, so that takes care of our chapter 20 in Introduction to Business. This is our last chapter in banking. Interesting, a lot of stuff going on in banking. Remember, this chapter here gives you a good foundational understanding and this knowing that once you take me for finance or for other classes more specific into the banking, there's a lot going into the banking industry. It's constantly changing technologies. You got bitcoins that are part of this whole banking. The Federal Reserve says, hey, maybe we should look at a bitcoin. So if I have bitcoins, are they going to eliminate the banking system as we know it? Because remember, with the bitcoins and everything else, there's a system that is just a trading back and forth, a process, a mechanism, something like an internet. We don't need to have a bank. There's no interest. There's no usury rate. Yeah, as long as you have the Bitcoin and have the passcode and everything else, I could transfer money back and forth, and no one knows where the money came from or how it goes. And that's the issue with the government. They can't track the currency. They don't know if it's done through drugs or some illegal operation. All right, but that's the financial banking system. So we're done with chapter 20. Yeah, that means you're almost at the end of this. Is the last chapter in this series of Introduction to Business offered at the college utilizing a Blackboard course management system. And this is the last time, so I'll see you within the forums talking about the banking system. Again, my name is Dr. George Mochocki, and you're almost done. Thank you very much for listening.